Silver markets experienced sharp volatility over a 48-hour period, marking one of the most significant price swings in recent sessions. The metal declined from $96.40 to $78.60, representing a 19% drop. During the same session, the Dow recorded a substantial decline, while the US dollar advanced to a 6-week high. Economic data added further pressure. The ISM Prices Paid Index came in at 70.5, the highest reading since June 2022, reinforcing inflation concerns and reducing expectations for interest rate cuts. As prices moved lower, margin calls triggered widespread liquidation of leveraged silver positions. Selling pressure pushed the market through key technical levels, including the 200-period moving average at $87.69, and continued below that threshold. By Wednesday, March 4th, silver had rebounded to $85.64. JM Bullion listed an ask price of $86.77. Despite the recovery, underlying structural conditions in the physical market remained unchanged. Supply data from COMEX shows a continued decline in registered inventories. On February 9th, registered silver totaled 102,256,630 ounces. By March 3rd, that figure had fallen to 87,985,490 ounces. This represents a reduction of 14,271,000 ounces over 22 trading days, an average decline of nearly 650,000 ounces per day. Registered inventory reflects silver legally available to meet futures delivery obligations. Total COMEX vault holdings, including registered and eligible categories, stood at 355,173,810 ounces on March 3rd. In October 2025, total holdings were 532 million ounces, marking a 33% decrease over 5 months. Delivery activity in March intensified attention on available supply. More than 52 million ounces were delivered during the month, representing 10,526 contracts that stood for delivery on first notice day, February 27th. By March 3rd, 5,694 contracts had been fulfilled, including 607 contracts delivered on March 3rd alone. The pace of delivery is described as multiples of any previously recorded levels in modern COMEX history. At the same time, open interest in the May contract increased. On February 27th, May open interest stood at 78,864 contracts, equivalent to 394,300,000 ounces. By March 3rd, open interest had risen to 80,274 contracts, an increase of 1,410 contracts. This brought total May open interest to 401,400,000 ounces, even as March deliveries continued at elevated levels. With 88 million ounces of registered silver available, the scale of open contracts significantly exceeds deliverable supply. First notice day for May is April 30th, 2026, 57 days from the reference date. Before that deadline, holders must roll positions forward, close them, or stand for physical delivery. Historical comparisons provide perspective. In January 2026, approximately 62% of contracts entering the delivery window ultimately requested physical metal. In February, the percentage declined as prices peaked and cash settlements increased. Scenario calculations illustrate potential outcomes for May. If 10% of contracts stand for delivery, that would equal 40,100,000 ounces, or 46% of registered inventory. At 15%, deliveries would total 60,200,000 ounces, or 68% of supply. At 20%, 80,275,000 ounces would be required, or 91% of registered inventory. A 25% delivery rate would claim the entire registered category, with contracts remaining. International developments add further context. On March 4th, James Henry Anderson reported that combined Shanghai Futures Exchange and Shanghai Gold Exchange silver vault stocks had declined to 752 tons, or approximately 24,200,000 ounces, the lowest level in a decade. China's solar, electric vehicle, and electronics sectors consume about 230 million ounces of silver annually, placing vault stocks at roughly 5 weeks of industrial consumption. Bloomberg reported in November 2025 that Shanghai inventories had reached a 10-year low, and ING Analysis cited the lowest levels since 2015. Early March data indicates the drawdown has continued. In early March, Shanghai silver traded at a 17% premium to Western spot prices. Policy changes were introduced in January 2026. China implemented an export licensing regime, requiring exporters to maintain at least 80 tons of annual production capacity. On January 26th, the Shanghai Futures Exchange reduced daily silver position opening limits from 3,000 lots to 800 lots per session, a 73% reduction. Beginning January 28th, multiple Chinese silver and gold funds suspended new subscriptions. China accounts for roughly 17% of global silver mine production and exports between 4,000 and 5,000 tons annually. Exchange-traded fund activity also shifted. Since February 9th, retail investors sold approximately 15 million ounces through ETF redemptions. SLV holdings declined from about 842 million ounces in early February to near 827 million ounces at the trough. Across the broader ETF market, holdings fell from approximately 870 million ounces at the December 2025 peak to around 828 million ounces, a reduction of 42 million ounces. Despite this additional supply, COMEX registered inventories continued to decline, lease rates remained elevated, and backwardation persisted. As of March 3rd, SLV reported 30-day net inflows of $1,750 million and was trading at a 4.86% discount to net asset value. On March 3rd, the one-year silver swap rate stood at negative 2.973%. In a balanced market, forward pricing typically reflects the spot price plus the cost of carry, including a risk-free rate of around 4.25% and storage costs near 0.27% per year, adjusted for lease rates. Under normal conditions, the one-year forward price would trade several percentage points above spot. A negative swap rate of this magnitude represents an approximate 7.2% deviation from fair value when adjusted for the risk-free rate. The one-month lease rate is near 3%, compared with a 5-year average from 2019 through 2024 of negative 0.09%. The forward curve remains in backwardation, with near-term contracts priced above later months. The Silver Institute projects a 67 million ounce deficit in 2026, marking the 6th consecutive annual shortfall. Cumulative deficits since 2021 total approximately 820 million ounces, roughly equal to 1 year of global mine production. Photovoltaic applications consumed about 230 million ounces in 2025, with each solar panel requiring approximately 20 grams of silver. Industrial demand from solar energy, electric vehicles, electronics, and defense applications continues to account for significant usage. As of March 4th, silver traded near $85. Registered COMEX inventory stood at 88 million ounces, while May open interest represented 401 million ounces ahead of the April 30th first notice day. Lease rates remain elevated, swap rates remain negative, and Chinese vault inventories remain at decade lows. These data points collectively highlight the divergence between paper pricing and physical supply conditions as the market approaches the next major delivery window.